30 companies on a fundamental basis. I measure their operating cash flow, free cash flow, match it up against their, enterprise value, and, try to make a portfolio of 5 of them that I believe are going to do the best, that are my favorite 5 picks. Over the past 5 years, they've done great. They're up 401% versus, the SIL ETF, which is a basket of silver miners. That's up less than 100%. So, I'm blowing away the benchmark. I know these companies on a fundamental basis. I know the management. I know the good guys. I know the bad guys. I go down to the mines. I've gone on a lot of great mine trips. Haven't been on one in a couple of years due to all the COVID stuff, but hopefully going down soon, and actually bring some of my readers along. Like we're doing a video here. I want to do a video on my next mine trip. It's pretty cool. But I've been doing it for 10 years, so I've seen a few cycles, both up and down, and I've got the experience, and so far so good.
So here at Wall Street Silver and the greater Wall Street Bets community, we have a lot of people who are just getting into investing and they don't really know too much about it. So talking about like the mining industry in particular, what would you recommend to the average investors? Because you have all types of mining vehicles. You have ETFs, juniors, majors, producers, and explorers.
Yeah, that's a big question. First of all, you got to buy PSLV, right? The Sprott ETF. It's a closed-end fund. It's not a open-end ETF like SLV is. And SLV, as I'm sure as you've been reading, you read their prospectus. The silver's not even allocated. Like there's a huge vault in London which has a lot of silver. JP Morgan owns a lot of it, and then they just on paper, if a lot of funds come into the SLV, they'll just switch some ounces virtually in the warehouse, and in the end you're not really sure what JP Morgan owns and what the SLV owns. And then you got all this silver sitting there, and with bankers, what bankers do when you give them $1, that's a liability of theirs. And what they do is, they will loan it out 1,000 times over. If everyone shows up at the same time to get their dollars back, there's not enough dollars, but they just delay it a little bit and then everyone gets their dollars back. But bottom line, those dollars are the basis for the whole, the whole fiat currency debt system. And they're doing the same thing with the silver ETF. They got a whole big pool of it right there, and bankers got a bank, and it's just sitting in a warehouse. So gold, I'm sure it's loaned out, rehypothecated many hundreds of times over. And silver, they're doing similar things with silver. But that only, it's a big question. Like that's only, which ETF. So it's a PSLV over the SLV. And then as far as, mining equities, the thing about miners is they're cyclical. They go up and they tend to go down. So you got to get your timing right. It's not like Apple computer that can make an iPad and then the next year they make an iPhone. It's, miners have, projects that cost hundreds of millions to build. And then once they reach the end of the life of the mine, they need to do the same thing again. And it's hard to do that, very hard to do that, on an accretive basis. It is a capital intensive business. Whereas, like Apple and, Google, it's intellectual capital. You work hard, you can create, hundreds of millions of ideas. Mining's not like that. Mining, you need significant assets in order to spend the CapEx, in order to build the mine, to extract the cash flow. And if you get your cycles right, you can make a tremendous amount of money. And, it seems like we're in a pretty good cycle right here.
Definitely. The silver squeeze has really brought a lot of attention to average investors about precious metals. Can you talk about some of the things you look for, particularly in a mining company?
Yeah, well, the first couple things, management's number one. You got to find good managers that are experienced, that treat their shareholders well. After being in the industry, and this could be any analyst position, but there's companies out there that don't care about their shareholders, and especially in the mining industry, there's a lot of mining companies out there. All the management wants to do is get paid every single quarter. So what they're going to do is, if they can't get it from mining, they're going to extract it from shareholders, and I call that, mining shareholders instead of mining silver or mining gold. And you got to stay away from companies like that. And the way I know that what's a good company, what's a bad company, is because I've been in the industry for like 10 years, and the industry is based in Vancouver and it's based in Toronto. All these guys know each other. There's brothers-in-laws that are directors of their relatives' company, and a CEO that's on the board of their other relatives' company, and it's pretty incestuous. So you got to know the good guys from the bad guys, and I try to stick with the good guys. And then the second thing is, you got to look for grade. Grade leads to more ounces in a ton, leads to lower costs, leads to higher profitability. There's a lot of lower grade projects that would work at higher metal prices that some people get amped up about. But I tell you what, there is gold in seawater. It's extremely low grade, but there's very little trace gold in seawater. And if gold goes high enough, it will become economically feasible to mine seawater. So are you going to start accumulating seawater right here? I don't think so. That's why I stay away from the low grade ones, because they're marginal. A bank doesn't want to give them a huge loan for hundreds of millions of dollars if their project is only profitable at $25 silver. So the grade leads to profitability, so you have a higher margin for error. And those are the two main things that I look at. And then the third thing where I make my decision is, I build out models for, these mines, right? You get your expected capex, you get your expected tons that you're running through, your expected grade and recoveries, and your costs. You got to figure in your costs. You do a NAV, you do an IRR to put a value on a project, and you compare that to the company's enterprise valuation. And what happens is, when you put a NAV target on a mining project, and it's a lot higher than what it's trading on in the market, that's an opportunity. And over the past few years, Silvercrest Metals leaped out at me, and most recently New Pacific has been over the past couple of years. There's just been a mismatch between enterprise value and what the project is actually worth. So those are the few things I look at. A company like First Majestic, it costs them $13 to get an ounce of silver out of the ground, so their margin's $13.